Okay. So, first of all, I want to welcome everyone to the lectures, Economics Prize Lectures for 2013. My name is Per Strömberg. I'm a member of the Prize Committee for the Economics Prize. And this year's prize, we've awarded empirical research in asset pricing or finance, which deals with to what extent you can predict future price movements of financial assets like stocks, bonds, or real estate. Turns out that this notion of predictability is a very important test for how well markets work, and we really want these financial markets to work well because they decide, that they have a big impact on the way firms and investors will allocate resources in the economy. We have 3 laureates. If I start with Eugene Fama from University of Chicago, basically started this literature in the 1960s and looked at to what extent prices could be predictable in the short run. And it turns out that if the markets work well, if prices are right in financial markets, it should be very hard or impossible to predict future price movements. And the research that Eugene Fama did pretty much confirmed this. It was extremely hard to predict prices in the short run. Now, in 1980, or around 1980, Robert Shiller started studying predictability over longer horizons and volatility of financial prices, asset prices over the longer run. And it turned out there you could actually get a fair amount of predictability in prices over those horizons. Now the question was then, is this a sign that markets are not working well, or could there be something else going on, for example, that the risk preferences of investors change over time? Now it turns out it's very hard to test these models, and here Lars Hansen did some path-breaking research in developing methodologies to test these complex models, and also made some very important tests of the standard models and rejected them. And the research of these 3 laureates have led to incredibly rich literature in finance, taking various paths, some working with more rational models of investors, some working with behavior models and market frictions. And thanks to them, we know a lot more about how financial markets work than we did before. So with this little introduction, I'd like to call our first speaker up, which is Eugene Fama. Gene was born in 1939 in Boston, and he spent 50 years, pretty much exactly, at the University of Chicago as a PhD student and as a professor. And he's currently the Robert McCormick Distinguished Service Professor of Finance at the Booth School of Business. Please, Gene.
Thank you, Per. Thank you all for coming. So the title of this talk is 2 Pillars of Asset Pricing. I really wanted to call it the Siamese twins of asset pricing, but I didn't think that was noble enough. And you'll see why I prefer that title if I exposit this in any clear way at all. And it's really 2 branches of research. One is about efficient capital markets, which Per mentioned, and the other is asset pricing models per se. And those are the 2 branches that I've worked on for 50 years and that I'm going to talk to you about. I always say I can give you my life's work in 10 minutes or a whole quarter. You're going to get the 30-minute version. Okay, so we start with efficient capital markets. And I go back to when this was really starting. In 1962 was a really propitious time for PhD research at the University of Chicago. Computers were coming into their own, liberating econometricians from their mechanical calculators. It became possible to process large amounts of data quickly. Stock prices are among the most accessible data, and there was lots of interest in studying the behavior of stock returns. primarily at the University of Chicago and MIT. It was clear from the beginning that the central question is whether asset prices reflect all available information, what I labeled the efficient markets hypothesis. The difficulty is making the hypothesis testable. We can't test whether the market does what it is supposed to do unless we specify what it is supposed to do. In other words, we need an asset pricing model, a model that specifies the characteristics of expected asset returns in a market equilibrium. Tests of efficiency basically test whether the properties of expected return implied by the assumed model of market equilibrium are observed in actual returns. If the tests reject, we don't know whether the problem is an inefficient market or a bad model of market equilibrium. This is the joint hypothesis problem that I emphasized in my 1970 Journal of Finance paper. In the early days before that paper, the key role played by assumptions about the characteristics of market equilibrium and tests of market efficiency just went unrecognized. For example, it was common to propose that market efficiency implies that stock returns are unpredictable from past returns, which implies that the autocorrelations of returns, the correlations between current and past returns, should be indistinguishable from zero. Many early papers focused on autocorrelations. The implicit model of market equilibrium, never acknowledged in the tests, is that the market is trying to price stocks so that their expected returns are constant through time. Market efficiency is always tested jointly with a model of market equilibrium, but the converse is also true. Common asset pricing models, like the capital asset pricing model of Sharpe and Lintner, developed in the mid-1960s, Merton's intertemporal CAPM, and the consumption CAPM of Lucas and Breeden from the late 70s, assume that all information is costlessly available to all market participants who use it correctly in their portfolio decisions. In other words, they assume a strong form of market efficiency. Thus, tests of these asset pricing models jointly test market efficiency. And that's what I meant when I said these are the Siamese twins of asset pricing. The joint hypothesis problem is obvious on hindsight, but its important in work on market efficiency was not recognized before my 1970 paper, which brought it to the forefront. That's kind of the characteristic of everything I do. It's obvious on hindsight, but it wasn't obvious before the fact. The second part of this section on capital markets is about event studies. So in the initial empirical work on market efficiency, the test centered on predicting returns using past returns. In a 1969 paper that I co-authored with Larry Fisher, Mike Jensen, and Richard Rowe, extends the test to the adjustment of stock prices to the announcements of corporate events. In the FFJR, the event is stock splits. But the impact of the paper, the long-term impact of the paper, traces to the empirical approach it uses to aggregate the information about price adjustment in a large sample of events. Like other corporate events, the sample of splits is spread over a long time period, in this case 1926 to 1960. To abstract from general market effects that can obscure a stock's response to a split, we use a simple market model time series regression. That's this little equation here. So in this equation, RIT is the return on a stock that splits its shares, not necessarily a month T, but this is just the return on a stock. This is a constant, this is a constant, this is the market return, and this is a residual. Now what these two terms pick up is the average return on the stock and its normal response to the market. Everything else goes into this term. So the effect into the residual term. So the effect of the split on the return shows up in the residual. And the tests focus on examining the properties of those residuals. Now the cute little insight that we had was if you really want to aggregate this information across all of the stocks that experience a split, you change the way you measure time. So you measure time relative to the event. So time zero, we only had monthly data at this point. Time zero is the month when the split occurs. Time minus one is the month before that. Time plus one is the following month, and so on. So what we did was we averaged these residuals across, I think there were 670 splits, in event time. So we get the average residuals. 30 months, we went to minus 30 to plus 30, from 30 months before the event to 30 months after the event. And we looked at those average residuals, and we also examined the cumulative average residuals. So we just cumulate that series of averages. Let me put up the. So this is this is the striking picture that emerged from that study. This is the plot of the cumulative average residuals from 30 months before the split. This is the split month here, and this is up 30 months after the split. And these are averaged across all of the 670 companies that did stock splits in this time period. So you see this is the path of what happens in advance of the split. So you see this cumulative going straight up. So what it says quite obviously is that companies split their stocks after they've experienced good times. And that's easily documentable in terms of dividends, earnings, and that stuff. Now, it looks like you can make money on this. Well, you could make money on it if somebody told you the split was going to occur. That would be really valuable information. But you don't know that until it's announced, and it's not announced until very near the event. But what market efficiency says is all the information that implies should get into the price at the time when the information comes out, which is time zero, and thereafter it should be just random. And that's exactly what you observe here. This is incredibly flat after the... So there's no more price adjustment, despite the fact that 75% of these companies continue to have good times in the years after the split. A little aside here, when we submitted this paper to a journal and it came back with a referee's report that said, "This is great, just publish it." That never happened again in my entire history, that they didn't request any rewrites of the paper. Now this paper, I'm bragging unashamedly here. This paper spawned an event study industry. I mean, there have literally been thousands of people that have studied different events to look at how prices adjust to the announcements of specific kinds of events. Finance journals are filled with them. This really was the paper that launched serious academic research in accounting. It was for a long time the most highly cited paper in accounting, and I'm not an accountant. So okay, so then we move on to a different topic altogether, predictive regressions. The early work on market efficiency focuses on stock returns. In a 1975 paper, I turned to bonds to study Irving Fisher's market efficiency hypothesis that the interest rate, IT, think of T as successive values of T's as a month. So the interest rate set at the beginning of the month for the period from T to T plus 1 contains an expected real return on the bond plus an assessment of the expected inflation rate. So the market efficiency issue is this prediction of inflation over the period covered by the bond, is it an efficient prediction? Does it use all available information? And that's what I set out to test in this paper. And the simple insight, again, a simple insight, was that if you want to extract the information about expected inflation in the interest rate, what you do is flip this equation over. And you put the inflation rate on the left-hand side, and you put the interest rate on the right-hand side. Because what a regression does is it gives you the estimate of the expected value of the variable on the left as a function of the variable on the right. And that's exactly what you're interested in. To what extent does this interest rate contain an efficient assessment of the expected inflation rate? Now again, this is an incredibly simple idea, but all the papers that had done this previous to this did the regression the other way. They regressed the interest rate on lagged inflation rates, which has a huge measurement error problem associated with it. Now, when you do it this way, you're using more than the information in past inflation rates. You're using all the information that the market used to set that interest rate. Now, there is a potential measurement error problem, what we call a measurement error problem in econometrics, because there is this term also in the interest rate, the expected real return. So in this paper, I proposed a very simple model for the expected real return. It's constant. If that's just a constant, it doesn't have any t's on it. What that says is the interest rate varies 1-to-1 with the expected inflation rate. So what we expect to see down here is this b should be indistinguishable from 1. And when I tested that on 1 month, 3 month, and 6 month treasury bills, this number was really close to 1, and these residuals were totally unpredictable from their past values. So interest rates set at the beginning of the month seem to contain rational forecasts of inflation over the month. The simple idea that the regression of a return on predetermined variables produces estimates of how the expected value of the return varies with the forecasting variables has served me and others well. When I talk about this in a familiar way, I say, when I come up with an idea, I beat it to death. And that's what I did here. I produced a sequence of papers that use this simple insight in a variety of ways. So I initially used it in a sequence of papers to address an old literature in the term structure literature, which is how well do forward rates that can be extracted from the prices of longer term bonds forecast future short-term interest rates. These papers introduce what I called a complementary regression approach, basically 2 regressions run simultaneously, that split the information in forward rates between near-term expected returns on longer-term bonds and forecast of future short-term interest rates. Now, I kept trying to do this in a way that I could explain in a short amount of time, but to do it properly, I have to introduce so much term structure notation, I said, it's not worth it. So, suffice it to say that most of the information in forward rates seems to be about near-term expected returns and not about short-term interest rates. In a 1984 paper, I applied the complementary regression approach to study forward foreign exchange rates as predictors of future spot rates. Again, the information in forward exchange rates seems to be about risk premiums, and there is little or no information about future spot rates. The exchange rate literature has puzzled over this result for 30 years. One of my young colleagues, just before I left, gave me a manuscript in which he takes up this issue one more time. Using the complementary regression approach, in a 1987 paper, Ken French and I, my longtime co-author, find that futures prices for a wide range of commodities do show power to forecast future spot prices, which seems to be the exception to the general rule. Now, the next topic is time-varying expected stock returns. Early work on market efficiency generally assumes that equilibrium expected stock returns are constant through time. This is unlikely to be true. The expected return on a stock contains compensation for bearing the risk of the return. Both the risk and the willingness of investors to bear the risk are likely to change through time, leading to a time-varying expected return. The trick is to find predetermined variables that can be used to track expected returns in forecasting regressions. In a 1977 paper, Bill Schwert and I document variation in monthly, quarterly, and semi-annual expected stock returns using regressions of monthly, quarterly, and semi-annual stock returns on predetermined interest rates. In later work, the popular forecasting variable on the right-hand side of the equation is this, the dividend yield, the ratio of dividends for the year preceding month T divided by the price at the beginning of the month. The motivation for this regression, which I attribute to a 1978 paper by Ray Ball, is that a stock's price is the present value of the stream of expected future dividend, where the discount rate is approximately the expected stock return. Thus, a high stock price relative to dividends is likely to signal a lower expected return, and vice versa. The word likely is needed because the price also depends on expected future dividends, which means the dividend yield is a noisy proxy for the expected stock return, a problem that Bob Shiller and John Campbell emphasized early on. The 1984 papers by Bob and Mike Roseff are the first to use dividend yields to track expected stock returns. In a 1987 paper, Ken French and I add an interesting wrinkle. We find that the explanatory power of the regression, measured by the regression R squared, the proportion of variance explained, increases as the horizon for the return is extended in steps from a month to 4 years. This result may seem surprising, but it is just a consequence of the fact that dividend yields are persistent. That is, they're highly autocorrelated. For example, with persistent dividend yields, the slope in the regression of the quarterly stock return on the beginning of quarter yield is about 3 times the slope in the regression of the monthly return on the beginning of month yield. This implies that the variance of the expected return estimate in the 3-month regression is about 9 times the variance in the 1-month regression. But the variance of the residual in the 3-month regression, this term, the unexpected part of the return, is only about 3 times the variance of the residual in the 1-month regression. As a result, R squared is higher in the 3-month regression. Higher R squared for longer return horizons due to the persistence of the dividend yield implies that the variance of the predictable part of returns rises faster than the variance of the unpredictable part. So in this sense, longer horizon returns are more predictable. But unpredictable variation in returns also rises with the return horizon. That is, the variance of forecast errors is larger in longer term returns. So in this more important sense, longer returns are less predictable. Bubbles. Now, efficient market types like me, I'm not ready for that one yet. Efficient market types like me judge that the predictable variation in expected returns on stocks and bonds is rational, the result of variation in risk or willingness to bear risk. In contrast, behaviorists argue that much of the predictability is due to irrational swings of prices away from fundamental values. In a 1989 paper, Ken French and I again addressed this issue. We find that the expected returns on stocks and bonds move together, and the variation in expected returns is related to business conditions. The general result is that expected returns are high when business conditions are poor and low when they are strong. The evidence that variation in expected returns is common to stocks and bonds and is related to business conditions leads us to conclude that the resulting predictability of stock and bonds returns is rational. Behaviorists can disagree. Animal spirits can roam across markets in a way that is related to business conditions. No available evidence resolves this issue in a way that convinces both sides. In a famous 1981 paper, Robert Shiller finds that the volatility of stock prices is higher than can be explained by the uncertain evolution of expectations about future dividends. This result implies that much of the volatility of stock prices is from time-varying expected returns. The market efficiency issue then is whether the variation in expected returns necessary to explain Shiller's results is beyond explanation by a model for rational expected returns. It is certainly possible to develop models for rational expected returns that produce this conclusion. But then we face the joint hypothesis problem. Do the tests fail because the market is inefficient or because we have the wrong model for rational expected returns? Now we come to this nefarious term, bubbles. Why do I put quotes around it? You'll see. There's one remaining result in the literature on return predictability that warrants mention. Specifically, stock returns are somewhat predictable from dividend yields and interest rates, but to my knowledge, there is no statistically reliable evidence that expected stock returns are sometimes negative. Ken French and I studied this issue in a 1987 paper, and the paper I wrote with Bill Schwert also examines it. This result is important. The stock market run-up to 2007 and subsequent decline is often called a bubble. Indeed, the word bubble applied to market becomes common among academics and practitioners after the traumatic events of 2008. A common policy prescription is that the Fed and other regulators should lean against asset market bubbles to preempt the negative effects of bursting bubbles on economic activity. Such policy statements seem to define a bubble. Now, I have to say it this way because when people use the word bubble, they never tell you what they mean. So such policy statements seem to define a bubble as a strong price increase that implies a predictable strong decline. Predictable strong decline. This also seems to be the definition implicit in most of the recent claims about bubbles. But the available research provides no reliable evidence that price declines are predictable. Thus, at least as the literature now stands, confident statements about bubbles and what should be done about them are based on beliefs, not statistically reliable evidence. Okay, so now we come to actually the topic that I've spent more of my time on. This is asset pricing models, developing and testing asset pricing models. The first paper that I did goes back in 1973 with Jim Macbeth. The first formal model of market equilibrium is the capital asset pricing model, the CAPM, of Sharpe and Lintner. In this model, market beta, the slope and the regression of an asset's return on the market return, is the only relevant measure of an asset's risk, and the cross-section of expected asset returns depends only on the cross-section of asset betas. In the early literature, the common approach to test this prediction is cross-section regressions of average security or portfolio returns on estimates of their betas and other variables. The other variables are included to test whether asset betas are indeed sufficient to describe expected asset returns. In a 1972 paper, Fisher-Black, Michael Jensen, and Myron Scholes criticized this approach because it produces estimates of the slope for beta, which is the premium in expected returns per unit of beta, that seem too precise, given the high volatility of market returns. They rightly suspect that the problem is cross-correlation of the residuals in the regression, which leads to underestimated standard errors. In a 1973 paper, Jim Macbeth and I provide a simple solution to the cross-correlation problem. Instead of running the regression of average asset returns on betas and other variables, we do the regression period by period, where the period is usually a month. It is easy to show that the slopes in the regression are monthly portfolio returns, whose average values can be used to test the CAPM predictions that the expected beta premium is positive, and other variables add nothing to the explanation of the cross-section of expected returns. Now, this little equation is a good example of that kind of test. So what this is it's a regression. Take all the returns on stocks for month T, regress them on this BI, that's an estimate of their betas, the supposedly important variable. This is the natural log of their market capitalization, which we call size, price times shares outstanding. And this is the ratio of their book value to their market value of equity, both measured at the beginning of the return period. Now, if this B suffices to explain the cross-section of average returns, the slope here, the expected value of this slope should be 0, and the expected value of this slope should be 0. Now, what we pointed out was when you run this regression month by month, each month what it produces is a portfolio return. This A1 is a portfolio return, this A2 is a portfolio return, this A3 is a portfolio return. And each of them focuses on the impact or the importance of the variable that it stands in front of. So the expected value of A2 should be 0, the expected value of A3 should be 0. A simple way to test that is to run this regression every month, take the time series of the A1s, the A2s, and the A3s, compute the mean, and just do a t-test against 0. Now, what happens when you do that is you're basically doing repeated sampling. The repeated sampling, the way these estimates vary through time, will be affected by the covariance matrix of these residuals. So that the time series jumping around of these slopes will pick up the effect of cross-correlations that was missing in the estimates that just ran average returns on the variables. So again, this is a very simple kind of insight, but it's a very powerful insight because you pick up the effects of cross-correlation without having to estimate the correlation matrix. In fact, estimating the correlation matrix is impossible if you have like 500 monthly returns and 3,000 observations on the 3,000 stocks in the regression. Now, they just gave me the card. I'm going to get gonged in 5 minutes here. So when we ran this regression, what we found was this average slope is negative. Small stocks have higher average returns than big stocks. This one is positive, and they're quite statistically significant, which says that beta is not a sufficient measure of expected returns. Now, the early evidence on the CAPM was generally favorable, but the golden age of the model didn't last that long. In the 1980s, violations labeled anomalies began to surface. Bonds finds that market beta does not fully explain the higher average returns of small stocks. There are other papers that show that the earnings price ratio adds to the explanation of returns. It's not captured by beta. Book to market ratios is the same thing. Now, these came out in a series of papers that looked at one of these anomalies at a time. And viewed one at a time in the papers that discovered them, the CAPM anomalies seemed like curiosity items that show that the CAPM is just a model and can't be expected to explain the entire cross-section of expected returns. Then in a 1992 paper with Ken French, we examined all the common anomalies together. Now, apparently seeing everything in one place led readers to accept our conclusion that the CAPM just doesn't work. The model is an elegantly simple and intuitively appealing tour de force that lays the foundations of asset pricing theory, but its major prediction that market beta suffices to explain the cross-section of expected returns seem to be violated in many ways. Now, in terms of citations, this paper is second in the Journal of Finance all-time hit list. The impact of the paper was really surprising, since there's nothing new in it aside from a clear statement of the implications of the accumulated empirical problems of the CAPM. So I have, 3 minutes here to explain 20 years of research. So this is the model that Ken French and I proposed to replace the capital asset pricing model. It's the so-called three-factor model. So what we did is we added to the market beta here, we added a second variable, small minus big. The difference between the return on a diversified portfolio of small stocks and big stocks, and HML, the difference between the returns on diversified portfolios of high and low book-to-market stocks. And then the regression equation used to test the model is this one. So no expected values down here. This is run in a time series regression, not a cross-section regression. Now this, Ken and I have many papers that address the empirical robustness of this model. Now it's a model. It doesn't work perfectly by far, but it works a lot better than the cap. Whoa, 1 minute, okay. So I have to explain 7 years of work now in 1 minute. So time is really getting close. Well, this model has become kind of the bogey that everyone in asset pricing tries to knock down when they have a new asset pricing model. It became, the work on market efficiency penetrated into applied work very slowly. This thing made it into applied work almost before the paper was published, that asset managers began to pay attention to the problems of the CAPM and to try to adjust their products to them. And then this simple model became the way that the industry started to measure its performance. So this little A here, that's the alpha of this model, the unexplained return, that in principle an active manager would add to the predictions of the model. Now it turns out they don't do that very well, but well, it's good to stop here actually, because the rest of it I would have talked about behavioral finance, and you really don't have to talk about that very long. Oops.
Thanks. Thanks a lot.
Oops.
So now I would like to call the next speaker up, which is Professor Bob Shiller. Which is not Professor Bob Shiller, it's Professor Lars Peter Hansen. Okay, I have an easy job, but I can still screw it up. Lars was born in 1952 in somewhere in Utah, or maybe not born in Utah, but you grew up in Utah. Got his PhD in 1978 from Minnesota. Spent some time at Carnegie Mellon, but then went to the University of Chicago, where he's the David Rockefeller Distinguished Service Professor in Economics and Statistics. So please, Lars, the stage is yours.
So thank you, Per, and pleased to have this opportunity just to share some of my research interests with you. So uncertainty. My research explores how uncertainty influences simultaneously financial markets and the macroeconomy. I address this challenge from the perspective of a model builder who used statistical methods. And these methods are used to understand both the strengths and weaknesses of the models under consideration. Now, today's talk is going to take a little bit of inspiration from someone that I only recently learned Alfred Nobel found influential, but Voltaire. So there's this quote from Voltaire that's, my French isn't great, but kind of doubt is not is not a very agreeable condition, but certainty is absurd. So why do I find that interesting? So I'm going to draw on a distinction here for some of my talk, for the latter part of my talk. It's a distinction that was really pioneered by a University of Chicago economist, Frank Knight. And it's a distinction between risk, where for me, risk are the probabilities assigned by a given model, and so-called ambiguity. So I'm going to call ambiguity not knowing which among a family of models should be used to assess risk. The skepticism that I mentioned from Voltaire is going to be skepticism about the model specification, uncertainty about the model specification. So I want to extend this. I want to think about a broad notion of uncertainty that goes beyond kind of more narrowly defined notions of risk. So throughout my talk, I'm going to try to draw an important distinction and vantage points. I'm going to think about researchers outside a model, and this is the more usual kind of statistician or kind of applied researcher perspective. Suppose I take a model. I take a dynamic economic model. With that model, a statistician can kind of estimate parameters and can also assess the model implications. Then I'm going to go and also talk about investors inside the model. So when you build a dynamic model, part of what you have to do is you've got to depict the economic agents, the consumers, investors, entrepreneurs, policymakers alike, and they cope with uncertainty, and one has to take a stand on that. And then we're interested in constructing the equilibrium interactions that acknowledge this uncertainty. So the rest of my talk, I'm going to try to sketch out a little bit of a historical perspective on time series econometrics and in particular rational expectations. I'm going to talk about some of my initial contributions to econometrics, the field that links economics and statistics, and then I'm going to talk about some applications and extensions. I'm going to summarize briefly what I see as the empirical challenge coming out of that, and then I want to revisit this more generalized concept of uncertainty. And I'm going to first explore how about from the vantage point of the investors inside the model. But then I also want to discuss it, I want to make some conjectures about uncertainty as it pertains to policy. So let me kind of dig way back here. There's if we look at the origins of the kind of modeling component to finance, one can trace this back to Bachelet. Now, Bachelet was one of the initiators of the use of Brownian motion. Now, his work wasn't really discovered by economists until like 50 years later, but the idea here was there's, financial markets, part of what they have to do is they have to figure out how to a response to kind of shocks that impinge on the underlying economy. Now, Relatedly, although these literatures did not communicate, Slutsky from Russia, as well as Yale, who is an eminent time series statistician, were building these models where they're trying to think about random shocks as impulses for time series that were themselves correlated. So the idea is, how can we take these random shocks as building blocks and produce interesting dynamic patterns in economic time series? Now, why the connection between macroeconomics and finance? Well, macroeconomic shocks, by their very natures, are things which you can't diversify, you can't average out. Those are the ones which investors, when they're exposed to, require compensation. So I find there a very natural link between macro and finance for this reason. Now, one of the initial Nobel laureates, one of the two initial Nobel laureates in economics was Ragnar Frisch. And Frisch was building, part of what he was doing was he was taking these Slutsky-Yule insights, but he was actually building formal economic models with economic inputs. And subsequently, Habermas pushed this a little bit further in the sense of how can we frame this in ways in which you can do formal statistical analysis. Now, the perspective of Habermas was statistical analysis from, say, outside the model. An econometrician's given a model, what does an econometrician or statistician do with it? But inside these models are investors, and these investors, are making decisions that depend on guesses of the future. And what this initial literature did was it kind of imposed convenient expectational mechanisms, so-called adaptive expectations, or appealed to empirical evidence on beliefs. And so there was interesting things going on inside the model. But the problem with this more limited view or this approach to expectations was it wasn't very useful as a policy tool. And here's why. So one of the reasons I'm interested and econometricians in general are interested in building models is that we want to use these models to do so-called counterfactuals, to do policy analyses that change the economic environment and see what happens. Okay? So once you start doing those experiments, you can't just hold fixed the beliefs of the investors inside the model, or else you can get nonsensical calculations out of it. And so Muth and Lucas took this very elegant simplification. They kind of said, well, let's use the model and presume that economic agents inside the model kind of figure things out in the so-called rational expectations approach. And so they endowed the people inside the model with a fairly high degree of sophistication when it comes to making beliefs. And then when you change the model ingredients, you had a very sharp prediction on what would happen to the beliefs of the economic agents. It kind of pulled off the table this notion of designing economic policies that systematically fooled people. So I find this to be a very powerful insight and a very useful, demonstrably useful one. Now, it also posed some interesting challenges for econometrics. So here the expectations are determined inside the model. This gave rise to a new form of econometric restrictions, so-called cross-equation restrictions, but it also imposed a challenge. It requires a complete specification, including a specification of the information available to economic agents inside the model. And I think of this kind of formal approach as initiated by one of my longtime co-authors and mentors, Tom Sargent, but also my initial paper was very much in the same lines as an economist. I'm a bit younger than Gene. So it was problematic to actually have this approach that really required that you had to do everything. So basically, to study this linkage between finance and macroeconomics, what you had to do is you had to build a model that was fully rich on the macroeconomic side and integrated formally the financial market structure in it. And especially for a wide variety of initial applications, this was really too much to ask. So I worked on this method, which doesn't have a very catchy title, I might say, generalized method of moments estimation. But what this was about is studying what is called partially specified models. It allows people, myself and others, to study this linkage between financial markets and the macroeconomy without having a fully specified model of both and a fully integrated model of both. This work was able to build on and extend an earlier econometrics literature, which was estimating single equations and simultaneous equation systems. So this idea of doing something without doing everything was certainly very much within the econometrics literature, and I give a key citation for for which my work builds from Sargan. What I was able to do was to extend and enrich in the underlying environment to have a much richer time series and dynamic structure, and to make it then therefore relevant to study these so-called rational expectations models. So let me just sketch out how the basic idea works. Okay, so I'll bore you with a little bit of math here. Hopefully not bore you, but maybe intrigue you, I don't know. But anyway, a key input into any dynamic model is some type of investment equation. It's going to be an investment equation: physical capital, human capital, financial assets, or the like. So in terms of this equation, think of this vector xt plus L as maybe some payoff and some investment that's going to occur down the road at time period t plus L. Okay. I'm going to look at its valuation from the standpoint of time period t. That's captured by this information set ft. But then I have to assign prices to this, or I have to assign valuations to this. And here I'm going to use a construct that's turned out to be demonstrably useful in building and testing models of financial markets, called a stochastic discount factor. Okay. So a stochastic discount factor here, if I use the ratio between date t plus L and date t, that's going to do the following. It's going to represent how markets discount the future, but it's also going to make risk adjustments. And the reason it's stochastic is in order to allow for there to be compensations for any exposures to aggregate economic risk. And so now I form this expectation. Say, think of this as a rational expectation, if you like. And then once I form that expectation, then I get the vector of prices QT. So this is like a very standard valuation problem. And lots of economics gets loaded into this stochastic discount factor specification. It can depend on investors' risk preferences, how they discount the future. It can depend on market structure and the like. And there's been a whole array of applications kind of mapping into this type of framework. Now, the expectation used here, instead of the one determined by a full model, I've not written down a full model here. This is only a piece of a model. And this equation by itself doesn't determine the entire macroeconomy at all, or the full dynamic economic system. It's just a piece of it. So the expectation here, instead of using the model, I'm just going to use the data generating process and the notions that investors inside the model kind of have figured that out, consistent with the rational expectations hypothesis. So how do you make this operational? Well, what I said is one of the challenges is the fact that we specifying the full information set of the investors FT. And so I've just rewritten that basic valuation equation here. And now just trust me, I know how to do matrix multiplication right, that there's a ZT of variables and investor information sets. I'm just going to do the appropriate multiplication. It's all, and then I'm just going to average out over the conditioning information set. So at this point in time, I no longer have to tell you exactly what FT is. I just have to produce a set of variables that are inside the investor information set. So the stochastic discount factor in these representations will often depend on data, which an econometrician can observe, but also model parameters. I can imagine approximating this by some time series average. I can build, and then from that you can build and justify formal methods for estimation and inference. And the key thing here is by proceeding this way, we avoid this complete specification of investor information. And these same methods can be extended, although I won't develop it here, to estimate and assess models that are misspecified. Of course, we know not all models are misspecified. That's the whole very nature of their model. And sometimes it's handy for a researcher to take a priori stands on what the model is good for and perhaps not. So what I described sounds very, very simple. It turns out there are some subtleties that go along with it. There's a whole bunch of ways to do the construction which I just described. There's a whole family of estimators that go with it. And it's then possible to take this problem and connect it to a very rich literature in theoretical statistics called semi-parametric estimation. So there's a parameter of interest here that feeds through the stochastic discount factor. But then there's also in the background some fully rich specification of a dynamic model, which is the thing which we're trying to avoid completely. So implicitly, that's treated non-parametrically. And then what you can do is you can kind of build in this apparatus and construct a whole well-defined notion of efficiency bounds for now a whole class of mini estimators. And I did this in subsequent work, as did Gary Chamberlain in complementary work. Now, this perspective I've described so far, it's useful to have, it kind of led me and some others to think about alternative ways to go here. For reasons I'll motivate in just a few minutes, sometimes it's very handy to ignore this kind of parametric structure of a so-called stochastic discount factor. To say, let's just even start more primitively. Let's suppose we know nothing about the stochastic discount factor, and let's go to the asset market data and figure out what we can learn about these stochastic discount factors. And so full characterizations of this I did in work with Jagannathan and a former student of mine, Letmer. Now, as I said, all models are misspecified. The perspective that the inferential methods that I described so far kind of presume that the model was correctly specified. So this led me to kind of think, well, how might we proceed differently if we just put on the table right at the outset that the model is misspecified? And this is important when we do comparison across models, across potentially misspecified models. It leads to a rather different perspective on both model comparison and on estimation. And this I also did with work with a variety of collaborators. I think I just went the wrong way. I put this upside down. Let me try this. Okay, so applications to empirical finance. Here, early on in my career, I kind of started my career out at Carnegie Mellon and subsequently went to Chicago. I had many important collaborators in which we pushed lots of empirical investigations in a variety of directions. And so here's some pictures of some of my early collaborators. I'm just going to talk about two of these contributions for the purposes of today's talk. Ken Singleton and I took the methods I just described and really studied formally these macro finance linkages. We took a so-called stochastic discount factor model, but one that macroeconomists of the day was kind of very typical inside their models. It was a very commonly used one. And others had speculated that this model might be problematic when it came to financial market linkages. We were able to use formal statistical methods and to characterize the limitations of this model as it confronted the rich array of financial market data. There's just too much, the type of heterogeneity, some of which Gene has described, that's really displayed in empirical evidence here, could not be tracked by this model. And what this led to was a variety of subsequent researchers exploring different investor preferences, different models of investor preferences. It also allowed to have people explore different markets, different structures of financial markets and the like. So it helped to set up a rather rich subsequent empirical literature, thinking about how to construct better models of stochastic discount factors. Now, as indicated before, it's also, I also found it useful to do this research that said, let's suppose we just go to the financial market data and see what it tells us about stochastic discount factors. Okay. And so we were able to produce some usable empirical characterizations with both Jagannathan and subsequently with Cochrane about characterizing with usable empirical characterizations that I argue have been empirically revealing. So let me give a not completely fair but somewhat superficial summary of key findings out of this, but ones that I think will serve this talk just fine. So let's think about the so-called, what I call the changing price of uncertainty. Okay, so recall these stochastic discount factors encode compensations for exposures to risk, so-called risk prices out of the finance literature. Now, once I understand better how stochastic discount factors, should be working in terms of pricing things, I'm learning that provides me. I'm learning things about these so-called risk prices. And kind of a basic finding is that this risk price channel provides a predictable and important source for variation observed in security markets. The earlier work showed that these stochastic discount factors were highly variable. This volatility or this variability was conditioned on information pertinent to investors. It wasn't just there because of investors observed more. Moreover, that a key insight developed subsequently by Campbell and Cochrane is that volatility is seemingly higher in bad macroeconomic times than good ones. So this opens the door to a modeling challenge. What's the source of this stochastic discount factor volatility? And I'm going to speculate on it in what follows. This is a possible explanation. So others have speculated on different ones. What about investors? concerned about misspecification, but now inside a dynamic economic model. So I spent the first part of my career rejecting a bunch of simple models. And kind of evolved to this notion that, that even more generally, models are misspecified. And maybe what we ought to be thinking instead is about how to use misspecified models in seemingly sophisticated ways. So before I kind of develop that more fully, it's useful to take a bit of an excursion under which, suppose I just imagine that I've got investors in the market and they got the wrong expectations. I call this a belief distortion. Okay? And this belief distortion then, I'm going to introduce this, in the top equation there, I introduce this E tilde. That's because it's some type of a distorted expectation relevant to investors. Now, there's a stochastic discount factor that goes along with it. Under that distorted expectation, that's the one that's assigning the appropriate risk prices. So I'm going to call that this S tilde T plus L over S tilde T is the corresponding stochastic discount factor that can depend, say, on observable variable and unknown parameters. Then the rest of the equation, as I've written before, the xt plus L are the payoffs in the future, and the qt is the price today, and the ft is the current period information set. Now, at the end of the day, I'm a model builder, so I can't just like write down some E tilde and say that I'm done. So it's convenient to take these distorted beliefs and actually represent them in a mathematically convenient way. And it's known from the applied probability literature how to do this. It's in these dynamic contexts, martingales, positive martingales can serve this purpose. And so the middle line here just uses that mathematical trick of martingales to represent what the E tilde is. It's what I do is I scale variables by this martingale, and that allows me to represent the distorted beliefs. So now I can go back and use that and see how this connects back to the earlier formula which I had for stochastic discount factors related to asset prices. And so I've just rewritten the top equation in the very in the third equation here, and you can see that it's what I picked up here is the counterpart to the stochastic discount factor that we're talking about before has two terms in it that get multiplied together: a martingale component and a stochastic discount factor that's making the adjustments for risk given the whatever expectations are the relevant ones for the investor. So that product formula is going to be very useful in framing my subsequent discussion. Okay, so I've just rewritten this. So we think about this M as capturing so-called distorted beliefs, and the S tilde as risk preferences that could also be capturing aspects of market structure. Imagine we can construct S tilde from data and model parameters. Now this M, these distorted beliefs, also have a connection to statistics. If I look at what's called a likelihood ratio between the distorted model and the original model, the correctly specified one, that's what this M is. When this M is 1, then there's no distortion. And when M is close to 1, the distortion is small. Statistical criterion, therefore, can be used to imply interpretable measures of the magnitude of this distortion. So what's the idea here? Well, we're kind of want to extend this notion of rational expectations in a way that's in interesting directions. When this distortion is small, a statistician, even with a large number of historical observations, will struggle to tell the difference between the two models. So one can think about the rational expectations paradigm as just giving these investors an infinite histories. And now this opens the door to thinking about, well, when are finite histories informative for some models and when they're not? So again, I've just rewritten the top equation: distorted beliefs, risk preferences. As I indicated, there's these statistical tools that support a refinement of rational expectations, allow us to kind of push this M away from 1, but in ways under which the idea is that if there's a lot of historical evidence that ought to be revealing lots about the model, then those are things maybe investors have figured out. Other stuff, maybe there's scope for distortions. So the inspiration behind this is that I want to detect when historical evidence is less informative. And I want to put some discipline on this scope of belief distortions. So there's lots of belief distortions that have shown up in the economics literature, going back to Keynes. Animal spirits are models that have trade, typically rely on heterogeneous beliefs. There's lots of speculations about the role of subjective concerns about events that occur very, very infrequently. And there's discussions of, say, the terms overconfidence. Okay? My argument here is that I expect these type of distortions to be more prevalent in cases in which historical evidence is weaker relative when it's far more revealing. So now the modeling challenge is I don't want to put everything in just some arbitrarily specified distorted belief, because that can get too much mileage out of that. Right? So I want to add some structure and content to the belief distortion, get precise ways to produce models of these belief distortions. And remember this insight from stochastic discount factors, that empirical work is the fact that the belief distortions, we want these belief distortions to be a substitute for these fluctuating risk prices. And we want them to imitate this notion that these seemingly risk prices, I'm now going to think of these as uncertainty prices, are bigger get larger in bad macroeconomic times than good ones. So the approach now is I'm going to turn back to this model misspecification and a more generalized notion of uncertainty, not one that's just tied explicitly to risk. Okay. So let me just remind us what our discussions of risk were, and add a little bit more formalism to it. So think about risk. I've got to suppose there's an outcome for next period, or call it Y. There's a current period state X, and it may depend on some parameter theta. And I can represent this, say, as a probability density. And the theta here is just some generic entity that indexes a whole family of models. And this could be a very, very large family of potential models on the table. Now, when I think about ambiguity, as I say, this kind of risk ambiguity distinction was pioneered by Knight. When I think about ambiguity, I'm going to think about there being a potential family of distributions that I'm going to put over the parameter theta. And they could be very degenerate ones, or they could have a fairly rich structure to them. Now there's some beautiful work that came out of Bayesian statistics. It was kind of initiated by Di-Finetti, and it was kind of provided full axiomatic treatment by Savage about how with enough structure, I can address this in a really simple and straightforward way. I come up with a unique pi, and then I just take and I average across the different models using that pi probability distribution. But if you go back and even read Di-Finetti and Savage, they themselves thought this was a nice, elegant result, but that in practice there was non-trivial issues about the specification of what this pi might be, and that sensitivity analyses would be in order. So I want to think about there being potentially a family of these probability distributions. And what I want to do is imagine, I'm going to imagine saying, well, I don't know which pi to use. Part of what I'm going to do is I'm going to look at the utility consequences of it. Which pi's matter to the decision maker because they have adverse consequences, and which ones don't. And I'm going to kind of lead to distortions for the ones that have the largest utility consequences. And so this is going to be implemented as a distorted model average. So this is going to give me, as implementation, some counterpart to that M, but it's going to come from it's going to come from the struggle about not knowing how to weight alternative models on the table, and to putting some type of, but still putting some type of limits on that exploration. Okay, and this type of approach that I'm talking about was really kind of pioneered by Wald a long time ago. Now, I'm able to build on ideas in order to proceed along this, and I've been doing this with my collaborator, Sargent. We could build on work from control theory, under which produces convenient ways to parameterize or represent rich classes of models. We can build on analyses coming out of Bayesian decision theory, where we think about robust counterparts. We think about, well, I don't know which prior to be using, and I want to do some type of prior sensitivity analysis. What's available, as I say, at the end of the day, I'm a model builder. What's available is some extensions of Savage axiomatic treatments in order to justify such approaches, as well as tractable representations, which is really key for my own research. So what can we get out of this? I'm not going to get into mechanical details, but let me just try to describe what you can hope to get out of this. So one can imagine a couple different skepticisms about models. So I can imagine some model in the future is going to change from the model we have, which seems relevant today, in ways that I can't really connect to historical data. So I might want to be concerned about those type of sources of changes in models. But on the other hand, there'll be other features of models that potentially can be learned based on past information. But even in those cases, there will remain some notion of prior ambiguity. So kind of what we can hope to get out of this, so what you can find in terms of doing calculations like this, and we've done this in a variety of different settings, is that consider this, suppose you introduce uncertainty to investors that has some form of persistence in the growth rate. So there's some type of uncertainty about macroeconomic growth. So we're in some type of recession, and we don't really know how persistent the consequences of this recession are going to be. And now start asking yourself, suppose there's high persistence. High persistence is going to be bad in bad times because things are bad, and if things are highly persistent, they're going to remain bad, so that would be bad news. How about in good times? Well, good times you would love things to be, growth rates to be highly persistent, but in fact, so what you're really concerned about is low persistence. And this changing perspective of kind of what aspects of model specification which you might want to be concerned about or be skeptical about, that becomes an interesting way to have these uncertainty prices to reflect, to fluctuate over time in ways that are interesting. So what this produces is an explicit model of these distorted beliefs that now has a much more primitive origins to it with concrete predictions. These are things which are computed out now in terms of the model itself and observable data. So let me just speculate for the last, very briefly, about uncertainty and policy implications. So for policy implications, there's kind of two approaches. One that's been developed extensively by and applied in various different guises. And this is I think, of uncertainty outside of a model. We take a structural econometric model. We can go to a policymaker and we can say, well, here's the amount of uncertainty about parameters or uncertainty about various different models. This has been done, it's been done increasingly recently in models of, say, relevant for monetary policy analysis. I think in general, it hasn't been done enough, but there's certainly been advances of that. But inside those models, investors typically have everything figured out. I think the more exciting challenge is this idea of equilibrium interactions within a model in which policymakers and the private sector simultaneously confront uncertainty. And in these type of scenarios, this kind of opens a new way for kind of very interesting interactions and some subtle impacts of uncertainty going forward. I will dispense with my speculations about financial oversight and uncertainty, which I think is which is a truly fascinating topic that I've thought about. But let me conclude. I look forward to learning from younger scholars who take up this exciting challenge of building even better models that link macroeconomics and financial markets in ways that cope with and confront uncertainty. Thank you.
Thank you so much, Lars. And now it's time for our third laureate. And this one, now I'm going to get it right. So I'm very happy to introduce Bob Shiller on stage. Bob was born 1946 in Detroit, got his PhD 1972 from MIT. I believe spent some time at Penn, and now is at Yale University in New Haven. So please, Bob.
Okay. Okay, it's a little bit difficult following two economists who share a lot of my concerns and interests, but I think also there's significant differences in our approach. I like to pick and choose. I've read both of them enthusiastically, but I think I have more desire to learn from other fields and disciplines. And I think that understanding speculative prices is not something for economists alone. I'm married to a psychologist, by the way. I'm going to be talking about speculative prices. I think over the years I've evolved into something a little bit more like a business economist. and less abstract. I'm going to show you plots of data. I'm going to refer to this, what Jean Fama called nefarious term, bubbles. Okay, that is, what is a bubble? You said nobody defines it, so I will define it. A speculative bubble is a fad. People get excited sometimes, too excited about phenomena, investing. Prices start going up, they start talking, the newspapers start writing about it. More and more people pile into a market and they push prices up more. And it goes on for a while. It can't go on forever and eventually breaks and the bubble bursts. I'll say it now. Gene thinks that there's, you didn't get to your point about behavioral finance, but I think behavioral finance is a very important component of finance that stands alongside the other approaches. I guess Lars was getting into behavioral finance at the end. Yeah, we are very like-minded in some ways, but I'm going to probably emphasize the differences here. So the idea, I think we date it often to Jean Fama, the idea of efficient markets is an idea that there are no bubbles. Everything that goes on in financial markets is smart people figuring out the facts. Efficient incorporation of information into prices. And as Gene says, however, what does that mean? Testable. What's testable about that? That's a very broad statement. So we have to make it into a model. And historically, I have a lot of slides. I'm going to just talk, and you can read the slides. There's too much here. But there's something called the present discounted value in finance. And the theory here is that the value of any investment, let's say a corporate stock, is the public's expected present value of the future payments it will make. So stocks pay dividends. If you buy a share of a stock, you'll get a check in the mail at regular intervals. And the idea is that the efficient markets theory prices all of those future dividends. So that's the equation that I have up there. And this is the simplest form of the efficient markets model, which our authors have already gone, Fama and Hansen have already gone beyond in their talk. But I want to start out, as Lars said, no model is exactly right. I want to start out with very simple stories and see how accurate they are. So this is the simplest story. It says the stock market, the price of, let's say, a share of stock is equal to the expected P star, which is I call it P star. It's the ex post rational price. It's what the stock market would be worth if people really knew the future. They don't know the future, but they make an optimal forecast of the future. And so I'm going to show you data, but I have to rush through this, given our time constraint. It'd probably take me 2 hours to deliver this properly. But, I also like to look at long historical data. So one thing you can clearly take away from this, that blue line here is the US stock market from 1871 to 2013. And that blue line is showing the ups and downs of the stock market. And you can see some big events. For example, I don't have a clicker, right? I can't, or do I? Can I move? Anyway, this is 1929, okay? This is the stock market crash of 1929. This is 2000. This is the stock market crash of 2000. The boom we're going through here is right up there, okay? Now what I've plotted alongside this is the actual market if everybody knew the future. And there it is. I've got two of them. The problem is I don't know the future after 2013, so I had to make some assumptions. So I've got two different estimates of the ex post rational stock market. Now I don't know if I've explained this well enough, but you can see that what I call the true value that the stock market would have if everyone knew history perfectly behaves pretty smoothly and steadily, but the actual stock market goes up and down a lot. I had a plot of this in my 1981 paper, but I only had it between these two lines because I was writing in 1981. It's a long time ago. Since then, the market has continued to behave pretty much the same. And the present value of dividends has remained pretty much the same. So I think nothing fundamentally has changed. My view of the world is this stock market is showing repeated bubbles. So the 1920s was a bubble. It burst in 1929. The 1950s, 60s was a bubble. It burst again after 1974. There are periods of enthusiasm and optimism. I know Eugene doesn't agree with this at all, but this is how science proceeds, right? We have different. I'm going to present evidence, so this is evidence right to start with. This clicker doesn't. This is just real dividends on the U.S. stock market since 1871. And there's a trend line fit through it. It's pretty trendy. It's been just growing something like 2% a year for 130, 140 years. It's grown faster in the last 10 years. You can see the blue line is dividends, and the red line is just a line fitted through it. And the stock price should kind of average out that. So stock prices really shouldn't vary very much. I mean, there's no historical reason, just in dividends. So maybe it's something else. Now this is parallel to what Lars and Eugene talked about. But the present value doesn't have to have constant discount rates. It can have discount rates that depend on interest rates. That's what I have in this model. Or it can have what Lars was saying was a stochastic discount factor. Or Eugene was talking about business conditions that might plausibly affect the stock market. So this is the problem. Efficient markets hypothesis doesn't say the stock market is unforecastable. So we can try other variations on market efficiency. And I've got a couple of them here. Now, I hope this is clear. What I like to do is look back at history, going really far back to 1871, and ask if people had valued the stock market this way and had known the market future perfectly, how would they have priced the stock market? And this is the thing. I have, again, this is a plot of this is an update of a plot in a paper I wrote 20 years ago or something like that. What I have here is the same. The blue line, again, is just the U.S. stock market. Now it's annual data. It's in real terms from 1871 to 2013. And the green line is the line we had before. It's the perfect foresight price, what the market would have by our model been valued at if people knew the future perfectly. But I've added on two other lines. One of them is this one here is the present value discounted by interest rates. And the other one here is the model that Lars was talking a lot about, the stochastic discount factor model. What you see is that none of these models seems to suggest a reason for the fluctuations in the stock market that we've actually observed. So I guess my attitude is, why are we so interested in the efficient markets model? Because we haven't seen any compelling evidence for it. Now, it may be that we have trouble rejecting it. It depends on your model of human nature. These various stories seem to have difficulty accommodating some fact. Like, for example, here, the stochastic discount factor model says the stock market should have been really high in the Great Depression. Why is that? Oh, this isn't, I'm sorry, the actual discounting with future interest rates model says that. Why? Because interest rates were very low in the Depression. So the stock market should have been high, but it wasn't, it was low. I just don't see any inspiration. I'm putting a very non-inspirational picture up for any of these models. So what I think is happening probably in these ups and downs of the market is we're seeing repeated fads or fashions or social epidemics that come and go. And they're integrated with the economy. They're difficult to understand. But in my 1979, 1981 paper, I argued that the stock market is too volatile for to be reconciled with simple models. It just goes up and down too much. It's because people are inconstant. I put that as a question. I didn't claim to have proven that either, but it seemed to me, judging from all of the evidence. Actually, this goes back to a paper I wrote with Jeremy Siegel in '77. Since then, other people have written about exactly this topic, including Lars Hansen and Ravi Jagannathan, who I see right over there. And there's been an enormous amount of discussion. I think this literature is not done. It continues to go. But to me, it appears that the market is too volatile. It's just noisy because people are a little crazy or a little bit. There's a social psychological component. And I think that it's difficult to summarize our state of knowledge of it. There are so many people that I respect who've talked about this in negative terms or positive terms. It's just not resolved yet. My colleague John Campbell and I, who was a student of mine at Yale, we wrote about a dozen papers about this. This is one paper that John Campbell produced, that gave a variance. I won't explain this slide, it's too complicated, but it gave a variance decomposition of stock market movements, and concluded that something like only about a half to or a third of the fluctuations in the stock market could be explained by evidence about future dividends. So most of the market doesn't make sense. There's a theory that John Maynard Keynes wrote about in the 1930s called the beauty contest theory. He said the stock market is not like, already precursors to efficient markets were being discussed. He said it's not like that. The market is like a beauty contest. Now he was referring to a particular beauty contest that he saw in the newspaper. Someone had a picture, some newspaper had 100 pictures of pretty faces, and they asked you to pick the 6 prettiest and send it into the newspaper, and you'd win if the 6 that you chose were closest to the average 6. But he thought, well, how do you win a contest like that? Well, you win a contest like that by you don't pick the ones that you think are prettiest. You think, what would other people think are the prettiest? But then again, that's not right either. You should try to pick the 6 faces that other people think are prettiest. He said the stock market is like that. You're not trying to pick the best companies. You're trying to pick the companies that in a month or a year, the market will come to like. So we're always trying to guess each other's psychology. Now, he wrote that in '36. It is very much alive today. And the profession is not all hooked on efficient markets. And we have lots of people here who are writing papers that are trying to, I think the beauty contest is emerging as a very important theory of stock market fluctuation. And these people are trying to figure out what it means for policy, how it helps us understand things like the volume or volatility of the market through time. And this is an ongoing thing. The other thing that I'd like to say, though, is that if you look at, everything I've said now is about the whole stock market, but if you look at individual stocks, efficient markets looks better. In fact, I'm referring to a paper by Tuomo Valtinaho that found that most of the fluctuations in individual stocks is due to information about future dividends. That's because there's more variance of the fundamental. This is a paper that I wrote with Jiman Zheng some years ago, where we looked at individual stocks. Now, the funny thing about the stock market, I asked Jiman to find for me a list of all stocks on the CRISP tape. That's from the University of Chicago. That lists stocks and their returns. Find all stocks that have been on the tape with no interruption and no change since 1926. It turns out there's only 49 in the United States. And what we plotted here is the dividend, is a scatter of the subsequent actual dividend growth against the dividend price ratio for stock. I don't have time to really explain what you're seeing here. But you see a negative, and each point is a firm year. And you see a negative slope here. The negative slope is what you should see in this thing. What I'm learning from this diagram, and you can go look at our paper if you, I don't have time to really establish what it, I'd like to talk for 2 hours if I could actually, but it shows that firms, that prices of individual stocks are not nonsense. For example, you see all the zero dividend stock, and you look at the expected return, they tend to have high dividend growth afterwards. People know, they know that some stocks are problem, and so the market price means something. So I'm not entirely negative about efficient markets. It works to some degree. I want to move then to my home price indices, and then I still have some time. The irony about economic research is that it often misses. It seems like we have fads and fashions in academic departments, just as we do in financial markets. There's been a lot of research on the stock market, much less on other markets. In the late 1980s, my colleague Carl Case and I decided to produce a price index for homes that is analogous to a stock price index, so that it could be used to evaluate homes as an investment. And it was Case who really came up with the idea in 1986 for a repeat sales home price index. And although actually Bailey, Muth, and Norse had proposed it in '63, never produced it. No one had ever produced an index like that. And we wrote a bunch of papers, Chip Case and I, and Alan Weiss. What we did then is we thought that nobody really knows how housing is done as an investment because the existing indexes weren't right. Funny, isn't that funny? Housing is just as big and important as the stock market, but back in 1980s, there was no reasonable housing price index. And so again, it's fashions and fads in research. It just hadn't happened yet. I find it odd. But we produced a home price index, and this is our plot of it from 1987 when we started producing it. Computer tapes were starting to appear. We could get millions of home sales, and we could calculate the index using a lot of data. Now there was another index at the same time, which was around. It was called the Constant Quality Index, produced by the United States Bureau of Census. So we produced a price index, but they weren't based on repeat sales. What they're looking at is the price of a constant house. Good, I have 10 minutes. I think I can stay in that time. What they're looking at is the price of a standard house, which has so many bedrooms, so many square feet of floor space, and a two-car garage, that kind of thing. And they go and they look at people who are building those houses today, and they compute an index of what that home price is. And that was what we had. That was the most scientific price index when we wrote. But we look at what happened. The census index never showed much of the bubble that we saw in home prices. And you have to ask, well, why not? I think the reason is that they were just pricing different houses at different times. When it gets expensive in the center city, home prices go up a lot, but that means that you can't build there anymore. Land is too expensive. So they build houses far out. And you're getting home prices, they're selling at cost roughly. And you know, it doesn't change much. What we developed was an index of existing homes. And we were very careful to make sure the changes in our index depended only on changes in the price of existing homes. And we discovered this huge bubble, which no one would have seen. We managed then to get the Chicago Mercantile Exchange to create a futures market based on our index. And while it's not a lively traded futures market, it's been going now for 7 years, and it continues to price. It's the only one in the world. It's based on our index. So what it's showing today, and this is, you can find this on the website, homepricefutures.com. It shows, the black line is the actual bubble, I would say, and burst in home prices. The peak was in 2006. And then we had this doldrums for years. And suddenly home prices started picking up. And then, now the green, that's actual. The green line is what the futures market is predicting. So we have a market in the Chicago that's predicting that home price, in fact, it ends in 2018. But when will it reach this blue dashed line, which is the old high? It looks to me like 2019, 2020. So we're having a recovery. The market is now starting to predict the increase, but it's predicting a slower increase than we saw the last time. Now the funny thing about these home price movements is they're big, and they're not explained by economic variables. So, for example, this is home prices divided by personal income for the city of Los Angeles. Los Angeles is a very bubbly city. I'll say that. That's my view of it. Why are they so bubbly? My sister-in-law from the area is smiling. It's because the Angelenos think that they're so special. They think they have the most beautiful city in the world. But they're not consistent. They get excited, and then they get upset, and it's related to the whole economy. I made a plot of. I tried to get as best I could a plot of home prices in the United States from 1890 to the present, and you can see that we've had an enormous run-up in home prices and then an enormous collapse. That's 2006. And building costs don't explain it, population doesn't explain it, interest rates don't explain it. I think it's a bubble, okay? And I know I'm not convincing Eugene Fama, but by the way, we're right now in Stockholm. We don't have a long time series for Sweden, but we have for some nearby countries. Norges Bank has a good home price index for Norway, and it shows a similar thing going up, except it's still going up. It didn't collapse like ours did. And I think something like that is happening in Sweden. Why are these things happening? That's something I think that we're learning more, and we don't have answers yet. But I'm guessing that it is a bubble. So there's been another revolution in finance that we call the behavioral finance revolution. This is what Gene Fama didn't get to in his talk. And I'm not getting to it as much as I'd like either. It's been going on for 20 years now, so that economists are bringing in psychology, sociology, and other fields more. Let me just mention some really important things. In 1893, French sociologist Émile Durkheim came up with the concept of collective consciousness. What he was saying is that the way we think at any time in history depends on what other people are thinking. We think the same thoughts. Certain ideas reverberate in our mind because we hear them all the time from other people. And then in 1925, Maurice Halbwachs, another French sociologist, came up with the concept of the collective memory. what he said is that what you remember at any point of time depends on what you've heard other people saying. You know, your mind forgets. Unless memories are reinforced, they just go away and you don't remember them. So you remember a set of facts that you've heard repeated many times. And when you try to evaluate things like the housing market, you are going to come to the same conclusions as everybody else because you don't remember some important facts. And you don't remember them because nobody's talking about them. I could tell you about the housing bubble in 1943 to 53 and use that as an example, but I bet hardly anyone here knows anything about it. If you could go back in a time machine, you could stop anyone on the street and they'd tell you about that bubble. But we forget, and so we repeat mistakes from the past. Irving Janis was a social psychologist who in 1971 wrote a book called Groupthink. And it's about how expert groups make terrible mistakes. And they do so partly for these kinds of reasons, but partly because of people's social tendencies, the tendency to self-censor, to not want to express opinions that deviate from the group opinion, and so on. Selective attention was talked about by William James in his 1890 Principles of Psychology. He said that people pay attention to certain things. There are structures in our mind that help define what we pay attention to. One thing is that there's a social basis for attention. We tend to pay attention to the same things as everyone else. So we get reinforced in certain fallacious beliefs at one time or not another because you just naturally look at what other people are looking at. The equity premium puzzle, which Prescott and Mehra pointed out, is an example of I think, kind of a selective attention phenomenon. In my book, Irrational Exuberance, I emphasize the news media as an important part of speculative bubbles that drives them. The news media amplify certain social epidemics, not maliciously, but they're a business and they have to attract attention. So they tend to focus more attention on ideas that are already in the public attention. I think that in understanding speculative bubbles, we have to be eclectic. And I think that what people are doing right now in the field of population biology, in the medical school, the epidemiology departments, and what's going also on in medical schools in neuroeconomics, we're learning more about the human brain. All of these research directions are changing the way we think about ourselves. And economics can't stand in isolation and ignoring all of these things that are happening. There's a lot of, to understand complex phenomena, we have to take account of every different kind of human expertise. But this is my last slide. Now, I want to say, though, that I've just made this strong pitch for other social sciences and for a broad approach to understanding economic phenomena. On the other hand, I come back to Gene at the end and say, yes, I think efficient markets is a worthy theory as a crude approximation. We have to teach it to our students. And I teach Fama and Hansen to my students because I believe that there is some truth to efficient markets. It's not perfect, but what it also means is that our financial markets are useful. They're useful, although they crash at times and they do the wrong things. But we in fact, in the future, ought to expand the scope of our financial markets so that there'll be more pricing. And unfortunately, there'll be more bubbles and bursts. But that's part of an imperfect world. But I've argued, I have a book called Finance and the Good Society that came out last year. I think that we will be pricing more things, not just real estate, but there are things like longevity. The European Investment Bank tried to create a market for longevity, lifespan expectations. It hasn't taken yet, but that's the kind of thing that will happen because it's an important economic concept. There should be a market for it. And there should be markets that capitalize flows like GDP or energy prices, or even occupational incomes. These ideas that might sound strange today will, with better computer technology and better understanding, help us advance to a better civilization. So what I've done is presented imperfect evidence along lines of my fellow Nobelists, but with a different emphasis, and with a conclusion that's maybe radically different about bubbles, but not radically different about the general importance of our financial markets.
So, and I would like to invite all of the laureates on stage and take the opportunity to give them another big hand. Thank you so much. Thank you, and this concludes the program for today.